Value investing is a term made famous by value investors like Benjamin Graham and Warren Buffett. It is one of the most common jargon that is heard in the investment world and probably the first jargon you'll learn when you start exploring stock investing. So, what on earth is value investing actually? Join me in this video to find out. Hi, welcome back to Mr. Money TV, your favorite financial edutainment network. Here we are, all about learning finance in a fun way. So if you like that, click the subscribe button and turn on the notification to follow us for the latest video. Also, do follow us on Facebook and Instagram for latest activities and updates. When I first started exploring stock investing, the first term I was introduced to was value investing. Well, all of us know that there's this one richest guy on earth that used this method to get to where he is today. The only guy who got into the richest list with investing when everyone else got there because they started their own business. Being the only guy who got there through investing, his method must be something, right? So let's uncover this super profitable investing method that got Warren Buffett to where he is today. Firstly, to understand value investing, we have to start by defining investing. Investment is an asset that you can hold on to and has the potential to grow in value over time. Let's do a simple test and see if you can get this part right. Which of these items is an investment? This? 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 This?
A few moments later.
Well, you get the point. Investment is an asset that can make you money as you are holding on to it. If it's not going to make you money or increase in value, it's not an investment asset. Now, let's define value. Value is what you get from a purchase. A good value means you are getting more than you pay for, and a bad value means you are getting less than you pay for. Let's look at an example. Your favorite noodles, Maggi Mee, would usually cost you 6 ringgit for a 5-pack set. One day, you went to Justco and you saw a promotion. It's 4 ringgit for a 5-pack set. Being a Maggi Mee loyal fan, you know that a 5-pack set of Maggi is worth 6 ringgit. So when it's 4 ringgit, it's a bargain, a good value. You're getting more than you usually pay for. So putting these two words together, value investing. Value investing is buying an investment asset at a lower price than it is actually worth. This investment method has been used by many great investors. Benjamin Graham, Warren Buffett, Charlie Munger, and the likes. Their method of finding and investing in high-value companies that are priced at a low price below its actual value has proven to be a profitable investment strategy over time. Now, how can you practice value investing in stock market? The key concept in value investing is to determine the actual value, or what we call intrinsic value, of a stock, and only buy the stock when the market value drops below the intrinsic value of the stock. Yes, there are two values for a stock. First, the market value, which is the price published on the local stock exchange. This price is determined by the market supply and demand. For example, there's a rumor that company A has a high chance to win a contract for the distribution right of a new COVID vaccine. With such good news, investors now anticipate that company A will have a strong business growth in the years to come when they win this contract. Therefore, more investors would want to buy the stock and less of them want to sell the stock, and this will drive the stock price up. Well, this also can happen the other way. If there's a rumor that says that company A will never win the contract for the distribution right of COVID vaccine, then less investors would want to buy the stock and more investors would want to sell it off, which naturally leads to a drop in the stock price. And in this example, we can see that the market value of the share on a short term is often driven by rumors and news. In the words of Benjamin Graham, the master of value investing, the market is irrational. The second value is what we call an intrinsic value. Intrinsic value is the actual value or true value of the share based on objective calculation and financial models. The intrinsic value is not always identical with the market value. To determine the intrinsic value of a share, one has to take into account of quantitative factors like financial position of a company and qualitative factors like the business model, management team, market, and industry. Therefore, it's of extreme extreme importance for a value investor to analyze the financial statement of a company and also spend time to analyze the business model, management team, market, and industry of the company. After analyzing the qualitative and quantitative data, you need to now use a financial model to calculate the intrinsic value. One of the most commonly used models is the discounted cash flow model. In short, DCF. Well, you can Google it up and find information on how you can use this model to calculate the intrinsic value of a stock. For example, you would like to invest in company A. You start by analyzing the financial statement, then study their business model, management team, market and industry, and then you calculate the intrinsic value through a financial model like discounted cash flow model. Then boom, you get your intrinsic value. Now, you just need to compare this intrinsic value with the market value of the company. Let's say you got 3 ringgit as the intrinsic value of company A, and right now the market value of company A is 2 ringgit and 50 cents. Then company A is considered undervalued and it's a good time to buy the shares. But if the market value of company A is 4 ringgit and the intrinsic value is 3 ringgit, then it's considered overvalued. Not a good time to buy the share. Yup, it's that easy. Just get the intrinsic value of the share, compare it with the current market price. If it's cheaper than the intrinsic value, then it's undervalued. It's a good buy. If it's more expensive than the intrinsic value, then it's overvalued. Don't buy. However, one thing you must bear in mind, there are many ways to calculate intrinsic value of a company, and there's no perfect financial model. And different analysts or people can come up with a different intrinsic value, even with the same financial model. Because everyone is different and they may place more importance in different areas. Like, one may be more conservative, hence they think that the growth rate of a business may only be 10%, while another person may be more optimistic and think that it could be a 15% growth rate. Everyone have their different opinions. Since the intrinsic value is only an estimate, it's important that we include a margin of safety. This is one important concept that Benjamin Graham teaches in his concept of value investing. The idea is to take into account that we can be wrong or overly optimistic when calculating the intrinsic value. After you've calculated the intrinsic value, apply a discount to it as a margin of safety. Like if you think that there's a possibility that you can be 40% wrong, then the discount of an intrinsic value by 40% should apply. For example, you calculate company A to be 3 ringgit per share and you think that you can be wrong by 40%. Then apply this to the 3 ringgit and you will get 1 ringgit and 80 cents. So you only buy the shares of company A if the market value dips below 1 ringgit and 80 cents. By applying the margin of safety, it will definitely make your investment choices more defensive, and you will only pick the shares that packs the most value for its price. It is like if someone sells you a brand new iPhone 12 at the price of 1,000 ringgit. Confirm it's a steal lah. Even if you don't want to use it, you can always sell it off at 1,500 ringgit. Basically, value investing method that was taught by Benjamin Graham focuses on buying shares at the most discounted price that you can get. Therefore, it's considered a very defensive investment strategy with potentially little downside and much more upside. Bear in mind that value investing is a long-term investment strategy. When asked about how long should you hold a stock, Warren Buffett, the legendary value investor, answers forever. So if you're looking for short-term trading, value investing may not be the best strategy for you. Value investing takes time to bear results, and it takes patience if you want to reap the benefits of it. On the other hand, one will have to run through pages of financial statements and compile market research data and scout for information relevant to the future growth of the company. Value investing is certainly one of the most popular investing strategy in our time, and one that has been proven through time as well by legendary investors like Benjamin Graham, Warren Buffett, Charlie Munger, Joel Greenblatt, and so on. In my opinion, a great investment strategy for mid to long-term investor, and certainly one of the best investment strategy that you must learn as you start off in stock investing. So, thank you very much for joining us in this episode. Share with us, what do you like about value investing? Or who are some of your favorite value investors of all time? We look forward to hearing from you. See you in the next episode.